Hey everyone. So today we are going to talk about how to successfully trade credit spreads, both on the put side and the call side. It is one of my go-to strategies because it defines your risk. It doesn't leave you open for any black swan events, meaning like if the market goes down when you short put, or when the market goes up when you long when you short call. So the idea here is to like create a credit spread with 80% plus probability of profit or nearby, around 78, 70, and anything above 75% probability of profit means that you have a 75% chance of winning in the trade. So here's my idea on setting up a trade which gives you that kind of probability. Um, you sometimes cannot find this in the tickers, in the stocks and the ETFs, but you can find this in the options futures market. The underlying market that I'm looking for to put a trade on today is the crude oil market. Now, the crude oil market is actually down quite a bit recently. So it's always good to like sell into the strength of the market, meaning when the market goes down, you sell the put side, and when the market goes up, you sell the call side. And the reason for that is whenever the market goes down and you sell into the strength of the market, meaning you sell the put side, means that you are collecting juicier premiums. And you can go further away from where the stock is, or from where the market is right now. So you can go further away. The volatility is high because the market has dropped. When markets drop, the volatility of the underlying goes up. You can check that for VIX and SPY and VIX and S&P 500 index. Whenever market goes down, volatility jumps up. So it's a good opportunity to sell the put side. Now, we don't just go out and don't check anything and then sell the put side. I have to know that this is getting close to its support level, getting close to its market bottom or previous lows, and then I'm going to get into the market. So right now, I think that the market has dropped quite a bit. It is up a little bit today. This is the crude oil market, which moves $10 per tick. Now, if you're not aware of all these ticks and sizes and contract sizes and all that and the notional values, I'm going to be making more videos on futures and futures options because this is the best capital efficient market, meaning you can get good efficiency in this market, good bang for your buck in this market, in the futures options market, versus the stocks and the ETFs. So I'm going to trade this market, crude oil. Hang with me, stay with me, and I'll show you exactly what I mean by how to set up a trade, which is over 75% pop and easy to make money. Now, let me introduce you or invite you to this 5-day trading challenge, which I'm running in 4 days. If you like it, if you like how I trade, how we trade selling options with good risk management, and if you want to learn more about our go-to strategies, which is the short puts, the short calls, and then the credit spreads. So these are the three strategies I talk about because I don't want to overwhelm people or my audience to with too many strategies. I know at least 15 of them, and I've traded them successfully over the years. I have over 10 to 12 years of experience trading options, short options. So these are the three strategies that we discussed in this 5-day period. I could have put all of this in a course, but then again, you would have bought that course and then you would have sat on it without any live support. Here, you get on a call, you get on these sessions 1 hour every day, or 1 hour 30 minutes every day. Within 5 days, you're ready to put your trade on. So that's the idea behind this trading challenge. Because I've taken these courses in the past. I've taken a bunch of courses in the past, and I've sat on them for months and years. I never really learned anything. I learned when I actually started putting the trades on, actually rolling them, managing the trade, managing the risk, adjusting the trades. That's how I actually learned the markets here, and that's how I've become positive P&L or P&L positive over the last 4 or 5 years. The first few years for me were also tough, and that's I think is the problem with everyone. Like they start buying options and then they lose a bunch of money and then they don't want to come back to the market. Here, you will make money 70 to 80% of the time, and then you will lose 20% of the time. Don't get me wrong, but we have some adjustment techniques that we can put out there to limit those losses. Now, there will be some losses, but we can limit those losses to whatever our defined risk is, whatever our max losses, or maybe even less than that. So go on this page. I'll put the link in the description. Only 50 takers. I'm not doing a class more than 50 this time, because otherwise it gets too big and then questions are not answered and all that. So um, look at this. All the information is on this page, and I'll put the link there as well. So let's get back to our credit spread trade. Now, if I were to take a look at CL, which is the crude oil market, yes, it's down towards 62 level, fine, which is also, if you look at this blue teal line, this is the 32-day moving average, meaning I have it as 32 days because my selling period is 35 to 45 days. And within those, within that cycle, I get maybe 30 to 35 trading days. Sorry, 30 to 32 trading days. So therefore, that's why I have a 32-day cycle. But I was just trying to cover a whole month, and that's it. Not even the 40-day cycle, 45-day cycle, but I'm just trying to cover a whole month. So let's take a look at okay, the trading the chain, the option chain. Now let's go back here. Let's take a look at how to actually pick the right strike. Oh, sorry, the volatility piece. We haven't really talked about the volatility piece. Yes, it is at the bottom right now of its range, slightly lower than what I would have liked to do. But here's the thing. I've even sold this in like low volatility environments, but then here you have to take profits early, meaning you don't want to wait until 50 to 60% of max profit. I would even take 25 to 30% and then just run with my money if the stock is up, if it's in my favor. The only reason I like this market right now with low vol is because it's at the bottom or towards the bottom right now. So I'm going to sell the put side and then try and cover the support level, which is around 55. Let's see if we can get it. Usually, before I even put the trade on, with my experience, I can get away with $7 to $8, meaning wherever the market is trading at 65 right now, 63, I can go down to 8 points away, meaning $8 away, and I can sell it at that level, collect enough premium, and sit on the trade. But let's see how the market goes right now. I haven't looked at it, I haven't seen it, but let's set it up. I'm just talking about my experience. Here we have 34 days left in the monthly cycle. Again, I don't trade weeklies because of the volume and low volume and interest, open interest. Here you can see the open interest is like in thousands, right? Look at this here. These two columns. This is volume and open interest. If you want to take a look at the same thing in the weekly cycle, you will see that it is not that good. So come back here in the weeklies. Look, there's nothing going on. There's only one contract traded at this price. Or about this one. This is also weeklies. Nothing going on. Maybe something's up with this platform here. But the monthlies is where the open interest and volume usually is. Okay. And we don't really want to go out 62 days because that's too much risk in a low vol environment. The volatility is going to jump up from here and not go down because it's already at the bottom of its range. So I'm going to pick the 34-day cycle. I'm going to pick this 34-day cycle and then go on the put side. And then I will select the 17 delta strike. Okay, 17 delta strike, not really much premium here, but let's see what the overall trade looks like. Usually I can collect about 130 to 150 in this kind of trade, but let's see what this shows us today. I'm going to sell a vertical, and I am buying. I'm going to buy. I always buy one strike out, so not the half strike, but the full strike. So if I'm selling at 57, I'm buying it at 56. Okay, this is giving us 150, so that's not a bad trade. Now let's take a look at it in the Analyze tab. Once we put the trade on, I also want to show you how to manage this trade. Putting it on is like, it's like a 3-year-old can actually do it with eyes closed, I think. If you know all these things, all the checks, if you have a checklist that you go through, anyone can easily put the trade on. But it's about managing the trade, meaning when it goes wrong, what do you actually do? Without panicking, because if you panic, you'll just take the loss and then move on, and then you'll keep losing money, and then you will give up on the market. So what do you actually do when the trade goes bad? But here's the thing. This is a 1 standard deviation probability range. You can look at it here. First up, let's put the trade on, and then let's talk about managing it, okay? 68%. You can also change this by going in and changing this to 2 standard deviation, and this will give you further out. but we don't really want to do that because then you don't collect enough money. So here's a good bang for a buck here. It's $150 max profit. Max loss is 150 because each tick is worth $10, and there's like $1,000 in between these strikes. Okay. So what I'm going to do here is let me just make sure I've checked everything. Yes, I have. Oh yeah, probability of profit. This was the main thing that I wanted to show you. 79%, like I said, you normally get 70 to 80% of max probability of profit, which is a really good number. And then going in the trade, it's a good number, but then it's all about managing and taking profits early in a low vol environment. So where will I take a profit here? If I'm collecting 150 minus the commissions, let me show you the commissions first. So your net profit, potential net profit is 150 minus 450 to get in, and then another 450 to get out. Now this is the paper trading accounts. I want to add something else here as well, that this is not showing the $3 something charge that the exchange charges for real trades on the broker platform. This is also a broker platform, yes, but it's a paper trading account, so that number doesn't come up. So it's usually $7 each way going in for a two-legged trade. Now this is a two-legged trade, meaning you are selling one and buying one at the same time. So it's a credit spread. So you will pay $7 to get in and $7 to get out without, if there are no adjustments or no, no rolls or no nothing. So your potential profit here is about $145 minus another $10, $135. So if I have to calculate the overall ROI, let's take a look at the ROI. So first of all, let's start from the beginning, okay? You do need to know all your numbers before you go in. So you're collecting 150, you're paying $7 to get in, then $7 to get out. So that's 136 left in the trade. Now, how much will you actually take and run with? That's a big question. So I would normally take about, just remember that number, 136. In a high vol environment, I would take maybe 50% of this, $75, okay? But here, because our IV is so low, I have got 150 total. I would probably take 30% and then go with it. So maybe even wait until $50 to come out. So if I do take 50 to 60, let's say if I take $60 out of the 136 that's left, that's a good ROI, right? You just need to rinse and repeat this trade for a good number. But if you do that 60 divided by the overall net, that's still a good ROI, which is 40%. So just remember, you can make at least 20 to 25% annualized just on this ticker. And if you continue doing that overall in your portfolio, just imagine, right? It's 20 to 25% annualized return versus anything else that's in the market. Now, when I say annualized, I mean you have to keep an eye on this. You can't just like put it on and then forget about it. Yes, you can for a few days, and then as soon as the target is hit, actually we did the ROI we didn't do the ROI correctly. So the net profit potential of, let's say we take 60, but I'm putting down $300. So that's the net ROI. Yes, otherwise it was too high. 20% annualized. That's a good number. That's the number I look at. 20% annualized. But annualized means you have to keep doing this thing again and again, and rinse and repeat. That's how you run the portfolio. You keep doing the same thing. If it's working, manage it, risk manage it, roll it, adjust it, whatever. I think you can make at least 20 to 25% doing these kind of strategies in your portfolio if you're careful and if you're engaged in the market. So let's send this trade in. This is a good number. I like this. Let's send it in. Let's see if we get filled here. I already have some positions here. I have a long Apple here, which I bought for like to show in some of the videos, and then I have an HP position. I don't know what I'm doing with that one, but anyway, okay. Let's just take one tick less just to like get it filled, because I want to show you like how to adjust this trade if it goes down, okay, and when to actually adjust it. This thing is not working now. Okay. Nope. Okay, let's change the overall premium to 14 here. Let's see if we get filled there. Not really. I don't want to sell it for anything less than 14, but in order to get this done and then I want to show you the other side of it if it gets breached. So let's just get it filled. But remember, I would not have sold this for this price. If I were doing this in my live account, I would have left it at 14 ticks. So just remember that. I would not have, 15 ticks. I would have just left it there. Right now we collected $20 less, and therefore our P&L is like down 20 already. But in my real account, I would not have done this. So just keep that in mind. I would have sold it for, I would have put this kind of limit order in for 15 ticks, which is 150 overall. So let's say you got the trade in, fine, and then now the trade is going back down on you. It's not going in your favor. It's not going up. With a short put, I forgot to show you the Greeks. Let's take a look at the Greeks. Your positive delta all the time. It's the price slices here, these ones. Okay, so your delta is positive. Let me bring this pin up. Your delta is positive, obviously 34. And where do you get the 34 from? So short delta minus the long delta. So let's go back here. Let me show you. So the short delta is 17. Long delta is 14. So the difference is $3 times 10. So there you go. So that's your 34. Okay. Or 32 now, which is fine as well. And then the next thing is your negative gamma. Okay, because you're not 45 days away, you are 32 days away or 34 days away, you do have some negative gamma. And this thing will just blow up. It will keep going negative for you as more and more closer you get to the expiration. So you really need to be careful on when to actually roll this. What would I do? I will tell you after I've gone through the Greeks. But let's see. So here we have positive theta. Obviously, we're collecting $2.56 every single day, and we are short Vega. So we are always short volatility when we sell options. Okay, so that's the main thing. Now, what will I do if it was going down? So how can this trade actually hurt you? It can only hurt you if the market goes down on you, right? Because you are positive delta. You'll be totally fine if the market goes up. So you want the market to either stay stable here, lose volatility. You want volatility to come down or stay stable, and then you want the market to either go sideways or go up. You don't want the market to go down, okay? And if it does, that's when you are in trouble. So if the market comes down here, then you're in trouble. So what would I do? I would start thinking about adjustment when this short put strike is not at 17 but at 30. That's when I would look at adjusting the trade. So meaning if the market drops to like by $3 or $3.50 on that day, I would look to adjust this trade. There's another criteria that I follow, which is I have to lose at least 1.5 times my net credit for me to make an adjustment. So I collected $130, let's say, for example. The P&L in the account has to be minus 130, between minus 130 to minus 200 before I make an adjustment. I think when the market drops by $3, that's where you will end up anyway. Okay, so those are the two criteria I look at. Now, here's the thing: you don't want to adjust too quick or too early, because then if the market goes back up on you, then you're stuck, because then you have moved your strikes, the trade is out of balance, and now you have to pay more commissions to like actually adjust more. So there's a mechanical rule that we follow, is when the short strike goes to 30 cents or 30 delta, that's when we think about adjusting, given how the volatility is going, and if the vol is high, we move the strikes up. And then what happens when we adjust? So here's the thing. Let's say the market goes down, the short strike is now sitting at 30 delta, right? I would sell in order to collect more credit, and if I have enough days in the cycle, meaning I need to have at least 30 days in the cycle left. So this thing, because I only have 34 days left, by next Monday or next Tuesday or next week, if this thing goes down on me, I will make an adjustment early next week, only if my criteria is met and I have enough days in the cycle. If I don't, then what I do is I just move this whole spread out to the next month. And the next month is the 60-day cycle, right? 66 days, 63 days. This is where I will move it. I will adjust the strikes down or up, or keep it there a little bit, try and collect either same amount of money or slightly less. A small debit is okay with me. $10 debit, $20 debit is totally fine to defend the trade. But if I have 30 days left in the cycle or 28, what I would do is I would sell a call spread to make it into an iron condor. And what I mean by call spread is this. So at a 30 delta strike, you will collect more credit. This is true. And at that point, I'm trying to close the delta out. So I'm short 30 delta here. Sorry, I'm long 30 delta on the put side. Let's say, for example, if the market drops, I need to collect short 30 delta to close the delta gap out completely. So therefore, I will sell at 30 delta, the call spread. And the call spread will be exactly the same. I'm going to go same number of contracts. And then I'll select this strike. Which strike did I select? 66, which is closest. I don't like the half strikes. You can check the volume and open interest on those half ones. So I don't like that. So now currently you're collecting 26. At the time, I don't know how much you would collect, but it should be somewhere similar. Okay, and then the trade will look like this. After the first adjustment, the trade has gone bad. It will look like this. And then what do we do? So we sit on this. Now we have defined risk on both sides. We just sit on it, get the theta collection going, wait for volatility, and now let's say we are down to last maybe 18 to 20 days in the trade or 17 to 20 days. We will look to adjust both of these out. Whichever one has come in, I will take it off. So let's say the short put side is now profitable, so I'm going to take that off. Okay, and I'm sitting with the short call strike. Short call spread. So then I will move that short call spread out in time into that 66-day cycle. And trust me, this mechanics have actually worked for me in terms of adjustment, in terms of overall delta, in terms of defending the trade, in terms of breaking even if it goes wrong, and in terms of being positive P&L in these trades. So I'm showing the exact method that I would do in order to collect 80% pop at entry, and then how to defend the trade. Now, like I said, there are a couple of things, a couple of ways I can help you. I do run some free option masterclass. The date is not set up for that yet. I think there is one coming up. Yeah, it's not set up. So I do need to change that date because it's, or one is coming up soon. And then there's this challenge, and then there's you can watch other videos on my channel. Drop me a message, whatever you would like to do, like in terms of what you want to learn more or learn about, and I can make a video on that. So let's stay engaged. Thank you very much for watching the video, and I'll see you in the next one. Bye-bye.